everyone, and thank you for tuning into the North Main Minute. I'm Joshua Dobie. We are in a different kind of world right now from an interest rate standpoint than really we have been for the last 15 plus years. And when I say different world with regards to interest rates, meaning they are substantially higher. Coming out of the financial crisis in 2008 and 2009, the Federal Reserve slammed rates down to a practical zero. And they left them there for a very extended period of time, at least relative to our history, better than a decade. And because of that, things like car loans and mortgages were microscopically low on a relative basis in terms of the kinds of costs that you needed to pay in order to secure that kind of debt. But it was also true on the other side of things, savings accounts, CDs, really not fun at all to leave money in there because in similar ways, very little interest was being paid. Now we're in a pretty much a 180 as far as the differences are concerned relative to the last 15 years because of the Federal Reserve raising rates over the last 20 months or so at a speed that we've never before seen in our history. So now on the inverse, when you're looking at things like car loans and mortgages, not all that great, actually not enjoyable at all from an interest rate standpoint compared to where we've been. Interesting sidebar, we're actually getting a little bit closer to what normal is. If you look over the last 60 or 70 years, we're actually getting closer to the normal end of things there, but compared to where we've been, it feels like a lot more expensive cost of capital. So that's one of the big things that we want you to keep in mind. The first thing we want you to keep in mind with regards to higher interest rates is understanding the differences in the environment and now the opportunities that you have perhaps on the savings and CD end of things, but needing to be a little bit more wary on the mortgage end of things, which brings me to the second big point. Be on the lookout for what happens to housing here over the next several months to a year or two. We anticipate, not that there's going to be a housing crash, but that it's going to look different. We're already starting to see that. The big builders are starting to slow down the number of single-family units that they're anticipating building over the next year or so. And we're seeing far fewer units, meaning in terms of transactions, the number of houses being bought and sold right now. Pricing is still pretty strong because inventory is so low. So it's kind of an interesting sort of dynamic that we're seeing there. We're not seeing this dramatic fall off in pricing in most markets around the country, but we definitely are seeing fewer units being transacted. So kind of interesting. We're going to be watching that. That's the second big point here over the next year or two. Third big point has to do with businesses. The cost of capital has gone up dramatically. For many large companies, especially large publicly traded companies, they use the capital markets to raise money. Very often they're doing that by selling bonds. Sometimes they're doing it with stock as well, but let's just look at the bond end of the universe for a little bit. You're seeing significantly higher interest rates those companies need to pay now in order to issue that kind of debt to the investors who buy them. And so that creates a different kind of balance sheet, if you will, for corporations who are looking to sell debt. Whenever it didn't cost them all that much and they could pay microscopically low interest rates on those bonds, we saw companies almost nonstop issuing debt because it just wasn't that expensive to do that. Now they're looking at a very different cost-benefit analysis. And so we're anticipating that kind of debt, and it already has, but it's going to continue to slow down more and more. And it'll be interesting to see what that means in terms of capital expenditures, especially for some of our largest companies out there. If you'd like to reach out to us at North Main Financial Group, maybe to talk about what do higher interest rates mean in your world? What does it mean in terms of savings possibilities? What does it mean if you need to move and you have to get a mortgage? Perhaps there are different strategies now to consider. Perhaps you're a small business and you're needing to finance a buyout or you're needing to finance an acquisition. You're wanting to talk about what that means. What does that mean in terms of how you manage that from a cash flow standpoint in this interesting time? We'd love to hear from you. NorthMainFinancial.com.